Hey, welcome to Advisor Talk. And this week we are talking to a great friend of mine, Keith Singer with Singer Wealth Management, located in beautiful South Florida on the East Coast there. And Keith and I have been friends for, I don't know, probably about 5 years or so now, met at multiple conferences and think a lot alike on a lot of topics. And Keith's a hoot and has some fun opinions on a lot of things. And so anyway, really glad to have you join the podcast this week. Keith, welcome on.
It's great to be here, David. You may notice my background. That's actually a picture of Fisher Island, which I believe is the wealthiest zip code in the country. So a lot of billionaires live there. But I want to say about you that I've been doing this over 25 years, and every now and then you meet an advisor that's really a savant at taxes, and they sound like they're an attorney. They actually know more than a lot of attorneys, but they're not attorneys, and you're in that small category. So I want to give you kudos to that. So,
well, I appreciate that. In fact, I do remember you and I were actually on vacation together. I think we were in Cabo, and I was eating like fresh guac, and you'd walked over. I think we knew each other about a year or so at the time, and on a napkin, I'm like, here's what you want to do, or whatever,
My place is great on The Office.
Yeah, that's right. Yeah, The Office, because somebody told me to go there, because the receipt always shows The Office, right? But anyway, so I appreciate the kudos. You're right. Tax planning's been my forte, and that's through personal pain, because people are like, how did you get this knowledge? Well, I got a nasty, I had a bad encounter with taxes myself and drove the passion. And for over 20 years, I've really been diving deep into doing just that, learning how the tax code works and how we can help our clients achieve better results via less risk. Because if you have to pay less tax, you don't need as much return to get the same result, right? So for a lot of our clients, they want to have all the things they want, but what they really want is they just want to know they're okay, right? I mean, clients want to know they're okay. That no one wants to volunteer and pay excessive taxes, and there's so many taxes. The average American, Keith, I don't know if you know it, pays over 59 different types of tax in a given year, according to the American Tax Foundation. And I paid over 81 year different taxes when we calculate them. And your cell phone bill, your cable bill, you have several of these little taxes and fines everywhere. In fact, we were just doing, I did a big educational webinar yesterday with over 150 advisors on it, talking about a hidden tax of IRMA, Medicare taxes that a lot of folks don't talk about. And so just putting that all together, once you start to realize all these different taxes, if you can just shave off a little here and a little there, it's monumental, the difference of what the net worth goes to, right?
Yeah, it's monumental, like you said. And you do have to be careful, because you and I both know that you see certain schemes that come along every now and then that look like it's a big tax savings, but it's not necessarily that black and white. It can be gray.
Well, there was an advisor. I've been an Ed Slott Master Elite Advisor in Ed Slott's tax program for many years, and there was a guy in there that kind of everybody that was in that program knew, and he was in your neck of the woods, and he's in prison currently because he crafted I think he called it the ultimate tax plan, and it was one of those too good to be true. I'm like, you don't need to go into the gray areas. You don't need to go offshore. I've been doing this my whole career, and I explain to people, the tax code has 1,700 incentives embedded in it to help you lower your taxes. If we weren't going to help you lower your taxes, we just have a flat tax rate, right? But we want to incentivize certain behavior. And so that's why they legislate. They want you to invest money. For instance, opportunity zones, which came about in 2017. If you reinvest your capital gains out of some investment, stock, bond, business, real estate, whatever, into an opportunity zone, you're helping economic develop in an area that was depressed. So you're creating jobs, creating opportunity, creating future revenue for the government. So therefore, you get a tax break, right? People need to understand these are not loopholes. They are incentives legislated into the tax code to help you lower your tax liability. The problem is nobody's going to do all the heavy lifting and learn the over 4 million words in the tax code. Well, I will, but because like you said, I like to read. Yeah.
I learned it in law school. It was very daunting, But, I like what Justice Brandeis once said, that he goes to work every day and there's a bridge that he could save some time, but it costs money, or he can drive around and not pay that toll. And it actually does public good because it reduces congestion. And he says, if I go through that toll and I don't pay, that's tax evasion. right? If I go around the long way and I don't pay, that's tax avoidance, and that's legal, and you're doing good for society. So there are rules and policies that were created, and we're giving tax. The government says we're going to give tax breaks for this, tax breaks for that, to encourage certain behavior. Now, granted, certain times of that behavior can be more than what was intended, but the rules are the rules, and as long as you use them, you're fine. So.
Well, I think you bring up such a great point. Tax avoidance and tax evasion, completely different things. One can put you in prison. The other one can give you a higher net worth, more spendable income, more peace of mind, and you're actually benefiting society. And that's why the incentives are there. So that's an awesome analogy. I'm going to have to go back and watch this later because I'm going to start using that. So I'm stealing that from you. So there's my first key takeaway. Thanks.
So Brandeis, one of the great Supreme Court justices.
Yeah. So let's now shift. You being in South Florida, deal with a lot of very high net worth clients. We deal with a ton of high net worth clients here, but it's not what I would call our bread and butter. My practice, for anybody watching this, is in Omaha, Nebraska, in Midwest. So we deal with a heavy flow of what we call the Midwest millionaire. They're savers out here. They don't carry a lot of debt. I did have an office in Florida, like the furthest south my office was. I had one in Vero Beach, similar, a few billionaires living on the island there. There, they had high net worth, but they carried some leverage, if you will. They didn't mind using debt, where our clients out in the Midwest don't like debt. They don't really use debt, et cetera. And it can be a good thing, by the way. But anyway, so we work with a lot of business owners and a lot of extremely high net worth farmers because their land has amassed in value. And some of them don't even realize that they're worth $20, $30, $40 million today because the assets have appreciated so much in the last 30 to 50 years. And so we're starting to do some planning for these clients because we have a big shift in estate taxes, as I know you're aware of, coming here at the end of next year. So we got less than 18 months to get plans in place for these folks. And you and I have used some strategies similar for clients like this that have appreciated a pretty high amounts of net worth, and through tax planning proactively, they can use strategies that will shelter assets that may benefit their kids, 20, 30 years from now, by using some of these strategies to get taxes off. So I want to talk about one in particular you and I both are familiar with and use, is private placement life insurance. Can you talk a little about your experience with this?
Yeah, this to me is probably the single biggest legal, no gray area at all way to simply never pay a dime of tax on your investments again. Okay. Now, there's a code in the IRS, section 7702, which gives life insurance incredible tax treatment. And again, we get back to the policy. Hey, the Congress says, hey, we don't want a bunch of orphans that we have to take care of. We want to encourage people to buy life insurance. So if they die, that their family we don't have to pay for them. There's money there. And so they said, fine, if you buy life insurance, we're going to give you some tax advantages. All the money is going to go tax-free. You can take it out tax-free through either withdrawal of your principal or low-cost policy loans. Whatever's left when you die is also income tax-free. So your money can go from $1 million to $10 million, and the government doesn't want 1 cent of that profit. Okay, that's extremely unusual. Now, most people don't design life insurance to maximize the cash of it. They're buying it for the life insurance. But it's funny, in the 80s and the 70s, people were creating these life insurance policies that had very, very small amounts of life insurance just so they could grow money tax-free.
Actually, Major League Baseball, most of the signing bonuses in the late 70s and early 80s were done through whole life contracts. $1 of life insurance, $1 million of cash stuck in there, if you will, and you got $1 million in a tax-free account, basically. And so I believe it was 1983 when Congress is like, well, wait a minute, we got to put some limitations on this, Keith, right? So basically, So basically, they came up with the MEC rule, basically, right? So
it's called camera, the law.
Yeah.
Basically, look, you can do that, but if you do that, you can't take the money out tax-free, but it's still going to be tax-free when you die, which still isn't a bad thing because if you have wealthy people, they don't necessarily need all their money. They just wanted to go tax-free. But remember, what were interest rates back then? They were 10, 11%. So you were making great money tax-free back then. It was a home run, okay? And then, interest rates came down. So if you look at like an ordinary life insurance policy, it might be paying 4 or 5% interest, which is nothing, to write home about. So now, fast forward to private placement life insurance, there's no rule that the insurance company has to invest the money in their portfolio, right? They can invest it wherever they want. So they can create, what we do is we create an account, we apply for the life insurance, and we're using the least amount of life insurance that the IRS require us to have, because then we keep the cost low. And then we send the money to insurance company, and the insurance company sends it back to us to manage at Charles Schwab. Okay. And they can have anybody they want manage that money except the insured. You can't be day trading that account. Okay, so that's
you can't direct it, et cetera. You've got to diversify it. There's some rules. You can't have more than 55% of the portfolio in any one singular investment. Over 80% has got to be at least split on 4 investments. But I think one of the things you mentioned earlier is what's the key here is for higher net worth people that are doing this. We can talk about the minimums, and you got to be a credit investor, but you're really going to be you need to be at least qualified or much higher net worth, 10 million and up, really. But you can actually get your money into private equity, to hedge funds, to alternative investments. As you and I know, alternatives are a key part of higher net worth folks that are not just the day-to-day market investments. And so they can invest through a series of hedge funds, if you will, within the policy and get that kind of return and growth, but they're getting it tax-free, where if they were in a hedge fund and experiencing, 25% a year returns and it's taxable, as you and I know we're in the same tax bracket, they would be paying to pay, and I live in a state where it's more, so you don't have the state to deal with 37 to 54% taxes on those gains every year. And this eliminates it, which gives you the compounding. I mean, I'll give you an example. I ran some numbers before we did this morning. So a 50-year-old that front loads $10 million into one of these policies, and if they got a 7% return in just a non-qualified account versus inside one of these policies, and let it compound for 50 years. Now, I know not everybody's going to live for 50 years, but we are living longer to 100. We're talking about $125 million in the non-qualified account, over $200 million in the life insurance policy. That would go tax-free. And of course, if you structure it right, you'd put it in an irrevocable life insurance policy, which you could do. It would pass estate tax-free as well. I mean,
right. Remember, a lot of people say, look, we need to start shifting our assets to the next generation so they don't have to pay estate taxes on it. The problem when you do that is there's no step up in basis anymore.
Yep.
Right. With private placement life insurance, it's a no-brainer because you don't have to worry about step up in basis. It's all tax-free at death. And so the question people want to ask is, okay, so what's the insurance cost versus what I'm saving in taxes? So if you look at, let's say you have a private credit fund that's paying 10%, you're in California, 5% of that 10 is going to taxes, right? Yep. And if you have an insurance costs, maybe 0.8% a year instead of 5%, it's gone to insurance. Now, I don't know about you, but when I pay that 5% of taxes, I don't get anything for it, right? At least when I pay that 0.8 to an insurance company, they're going to give me more money back than I put in when I die.
Yeah,
so,
the ROI is there. There's no question about that. And again, this is not for, and we can talk about it a little bit later, somebody who's maybe not quite at the stature net worth for this. We do have other options and alternatives for them, but they can't quite get to the level of the investments. And I think that's one of the key things here is we can get people into alternative private credit, as you said, hedge funds, private equity. You can get a myriad of things diversified in there that are meant to get you double-digit returns every year. And obviously there's going to be drawdown years, et cetera, but you're not paying taxes, and that additional compounding is massively expanding the value of your estate. And on top of that, if it's structured properly, you can take a tax-free loan against that, and you're not taking it from the investment account. You're borrowing money technically from the carrier themselves, general account, and it's contractual, right? At the time you set this up, they will loan you the money anytime you ask.
That's the 1% a year interest. Yeah, correct.
Yeah, correct. Yep.
So you can invest exactly how you're investing now, and it's your choice. You can do it in a tax-free world, or you can do it in a taxable world. It's really up to you. Now, a couple other benefits. I know in some states, this money is protected from creditors. Right. So you could have 20, 50, hundreds of millions in this, and no one could ever touch it if you got sued. It's a minimum level of wealth no one can take away. Now, I want to bring up something, David. Most people are not familiar with this, okay? Because life insurance agents are not selling this because they don't get a big commission.
Correct.
Right?
This is not your traditional life insurance policy that's paying somebody a nice fat commission on your premium, because we're buying that's just understand the structure for everybody who's watching. Life insurance, I'm a licensed agent. All the advisors that work for me are, but when we sell life insurance, we're paid on the life insurance component, not the cash value component, right? We're paid to sell the insurance.
Right.
And so exactly, these are structured the opposite way. And so we're buying as little life insurance as possible. So it's not a big, but full disclosure, we are both money managers. We would get paid to manage the assets within the cash value side.
Now, the money managers aren't recommending this either because they already have the money. They don't really understand the concept or how to even implement it. It's funny, you know who recommends this? It's the high-level tax attorneys. I've talked to people.
I have two exactly that only deal with like 25 million net worth families, and they're the only two people I know that proactively talk about this strategy that are in my circle of professionals I work with. And then occasionally guys like you, when we're sitting down having a cocktail at a conference and start, hey, I was doing one of these cases, and that's the cool thing is iron sharpens iron. Why I started doing these advisor podcasts is when you get in the circle of friends and guys that are dealing with similar case size, similar net worth, similar outcome desires. Most people want to pass the assets to their kids. There's some, I have one client right now, a potential client. He's not officially a client yet. It's close to 100 million in net worth, and he wants to endow a high school. Kind of a cool concept. Literally, the high school he went to is alma mater. So every kid that has whatever the requirements he's setting, like a 3.0 GPA, will be able to go to a college here in our state, and it's paid for. And right. I think that's pretty cool. And so, we try to sit down with these high net worth clients and explain to them, what is the outcome you want? Because they're not going to spend the money, right? And so once they get that realization, you're safe, you're good. And now let's talk about what's going to happen in a few years if you don't take action. And that's the cost of not taking action is pretty significant here.
Right. No, it really is. And I think, I'm just setting my own private placement insurance up right now. It doesn't make sense not to do it. I'll make such better returns than if I don't do that. And, if I was going to use a traditional policy, I can do better than that. Now, these are generally for people with at least a 5 million net worth. And, you generally have to put at least 2 million in over 4 years to even do that. But if, some people I've met people that have a couple of $5 million of whole life cash value and it's making 3-4% interest. You can just plop that into here and invest it however you want and make 10% interest, and the difference is enormous.
And again, that's just using the IRS code 1035 in the tax code. We can legally take it out of that policy, stick it into the new one, and it's non-taxable event. And therefore, now you have all that cash value, and we're accelerating the growth from the traditional exactly. Most of the whole life policies that we see, and I know I have a couple of myself, they're 3.5 to about 5.25 is what most of them are paying right now, right? Because it's based off the dividend portfolio of the company. And, there's some great mutual companies out there that are consistent payers, but exactly. Is 4% going to cut it in an inflationary environment like we've had these last few years? No. So
I bought whole life when they were paying 9%, and when they came down, I switched. Actually, there's something like if you don't qualify for private placement, the next best thing is an overfunded index universal life, because currently companies are paying, I think, based on the S&P 500, whatever it makes each year, but with a 12.5% cap. So in the up years, you can get up to 12.5%. The down years, you don't lose. So it's actually more conservative than private placement and more consistent, so you'd expect maybe 6 to 8% returns, but still tax free. But, if you don't qualify private placement.
I think a key point there too is the commitment level on those is not as strong as it used to be. In other words, you don't have to commit as long. Thanks to actually the CARES Act a couple of years ago, you can max fund one of those policies in 4 years and 1 day. And so you can actually, if you figure out how much capital that is available, somebody wants to commit to this, and basically make 5 payments, if you will, and let it go. You can keep funding it after that if you'd like, but you're only required to make those 5 payments. You can get it done in 4 years and a day, technically. So
I've actually had a client who said, you know what, I want a 20% in that out of my private placement for a couple reasons. Number one, the death benefit is also a long-term care benefit. So if you ever couldn't take care of yourself. And number two, when you borrow money from private placement, it costs about 0.8% a year. when you borrow money from certain insurance policies, like an index universal life, you actually make money on the money that you already borrowed. So there's actually that you
can lever, you can do interest arbitrage,
it's a negative cost loan. So, and they say, you know what, I don't mind having a piece of what I'm doing and something more conservative anyway. So there's a few reasons why people might want to consider that as a supplement to their private placement or as a substitute if they can't qualify for private placement.
So again, though, let's give some reasons not to do this, because sometimes people watch these videos and get excited. So let's talk about number one, exactly. When we're talking about the private placement, you mentioned $5 million. I would tell you, you probably need to be at least double that, in my opinion, in real net worth. Now, it may not all be liquid, right? Because these are commitments. You do want to front load these policies because you're buying such a little insurance. You're trying to get that cash value compounding in a tax-free account. So the more you get front loaded into it, obviously, the bigger the compounding effect that's going to be. When it comes to the IUL, the smaller policies, the index universal life that you're overfunding, same thing. You want to be able to figure out how much you can commit to and not underfund that number. Technically, you could keep the policy in force and pay less. There's a minimum amount of premium that you could pay each year, but then you're going to lose those benefits of the cash value. So this is not for you to go out in the faint of heart and just go to your State Farm or Allstate insurance guy. Hey, I was watching this YouTube video, and you need to work with competent professionals like Singer Wealth or Retire Smart here in Omaha. There's hundreds and hundreds of qualified advisors that do this stuff regularly, and so it's not for the faint of heart. And like I said, I talk with advisors that we do some tax trainings with, and I'm like, you want to split those cases when you start early in your career. You don't want to go do this on your own because if you do it wrong, it can be painful. And so, you just if this concept sounds good to you, talk with a competent professional. Take your time. This is not a 2-hour. Hey, this sounds good. Let's move forward. Right? You need to think this through and make sure it fits in with the entire rest of your plan holistically.
Yeah, absolutely. And if you have an advisor you love, see if they can do it for you. But if you don't know how to do it, then you're going to have to call someone else.
Yeah, and there's nothing wrong with that, right? As you know, our shop, we're so focused on taxation. When people come in and they've been with their other advisor for 15, 20 years, and they're like, but we really love, Joe or whoever it is. And look, I understand that. Joe did his job. Joe was an accumulation advisor. He took you from A to B over the last 15 years as you instructed him to do. However, Joe doesn't do tax planning. Joe doesn't do estate planning. Joe doesn't do, income, whatever it may be. And so sometimes you have to find the advisor for where you are in life. And that's sometimes when it can be hard because, again, I've got professionals that are my friends as well that I've utilized, professional attorneys, doctors, etc. But I still don't see my pediatrician. I had a great pediatrician, right, growing up, but it was time to move on to a different type of doctor, and the same thing is you need different type of advice, and you've got to work with professionals that are going to pull together the team. We use outside specialists quite a bit. I know you do. Keith has a law degree, by the way, and so one of the things that fascinates me is Keith has got the tax background, the legal background, etc. Not everybody has that amount of knowledge in there. So when you're going to a practice, we have an attorney on site. I have a couple of my advisors that have JD degrees as well. And so, you've got to seek out the competent advice for where you are in life and get the right type of advice. I have 14 licensed advisors on the team now. We keep growing fast, but I can't put all the clients with any of the advisors. There's experience levels, right? But the great news is the younger advisors. I just had two of my young, I call them my young studs, that passed their certified financial planning exams last week. So kudos to them, up and comers. But they get to sit in the room with experienced advisors all day, every day, and learn the advanced techniques. So give them a 10-year seasoning, and they'll be amazing advisors to go to for higher net worth clients. But again, just seek advice from competent professionals, man. I can't say that enough.
No, it's true. I mean, not everyone has the same qualifications. I actually own a separate estate planning law firm. 3 of our advisors are estate planning attorneys, and a 4th one is in Stanford Law School. He's going to start his 2nd year at Stanford Law School. So he's a smart kid.
Well, you've been opening up a couple locations there in South Florida, right? So
Tampa, we have, obviously Palm Beach, Boca Raton, Aventura. It's good. It's a very wealthy state, especially those areas. And
well, what an influx of high net worth clients you've gotten added to your state, right? Just due to, we've seen a seismic shift of high net worth clients fleeing, let's just call it blue states that have disincentives on their tax code: California, Michigan, New Jersey, New York, and they're flooding. And the number one benefactor that economically in the last 4 years has been the state of Florida. Texas, I believe, was number 2, and South Carolina, believe it or not, was number 3. And so people are moving to states that are friendlier. And again, clients that have net worth, that have resources, they can pick up and move. It's not that difficult for them to make that decision. They can afford to move. They can just go buy the new house without even having to sell the old house, etc. Where other people economically may be trapped in their financial situation. Like, I can tell you, there's millions of Americans feeling trapped just by their mortgage, right? They have a dual income. They're doing fine as a middle income America, kind of middle class, but they got a mortgage at 2.5% on their home. And if they wanted to sell, they'd have to go get a 7% mortgage today. So they can't make that move.
You know what else is great about Florida? They have robust asset protection laws. And so here's what's interesting. They may not have them in Nebraska. I don't know if they do or not, but it's actually could be an advantage, because if you buy a large life insurance policy or a large annuity, and then you become a resident of Florida, all of a sudden that will become protected. Right. So I had a client was making tons of money, was probably worth 20 million. He put a bunch of money in annuities and life insurance. He knew that it had asset protection. He never thought he'd, get a lawsuit against them that would, basically bankrupt him. But he had this huge judgment against them and they couldn't touch it. And it was unbelievable. Now, here's what's interesting. Let's say you're in Nebraska. In Florida, if you have a judgment against you and you transfer the money to a life insurance policy or annuity, they're going to come after you and say it's a fraudulent conveyance, right? But if you're in Nebraska and you do that and it's not protected from creditors, then you weren't transferring that money to hinder creditors, right? But then if you subsequently move to Florida and become a resident, then you'd have the asset protection. So you never underestimate having a minimum level of net worth and no one could ever take away from you, even if it means having to move to a state where that asset becomes protected.
Well, no, and I lived in Florida, as you know, for 3 decades, and I still own property there. My son lives up the coast in Melbourne from you, works at a hospital there. And I will tell you, we had a client get sued, and I was at one of the big broker-dealer wirehouses. We won't give the name out, but basically had a client get sued because the daughter worked in the medical field, got in a car accident driving in some fog right on A1A, and anyway, hit somebody that was making over $500,000 a year. They sued and basically won, but the car insurance she had, the limitations was about $250,000 that it would pay. So then, of course, they go after the assets of the person. Well, this person was a joint account owner with her mom that had substantial wealth, and they were able to penetrate and clear out over half of that account in the lawsuit. When, one, we recommend people never do joint accounts with your kids. You can just simply do a power of attorney and get basically all the same benefits, but do not make them a beneficial owner of the account for that reason, asset protection. But 2, if they would have listed and shielded some of those assets in some of the life insurance contracts and annuities, it would have been creditor protected, And so again, we try to help clients understand we're trying to protect you from the risk you don't even see. Right. And there's so much of it out there.
Every client that comes in, we're looking at their asset protection. In Florida and some other states, you have tenants by the entireties that is available to married couples. You can title accounts that way, and that's going to be protected from creditors. And it's going to be protected from an individual creditor of either the husband or the wife, because technically it doesn't belong to either of you. It belongs to the marriage. And so they can't touch that. 2 different times I've been deposed where clients had annuities or life insurance and the creditors are coming after them, asking about those assets, and they couldn't get them.
Yeah. Well, you bring up a great point, because I have a lot of medical practitioners in my and in particular, I have a very well-to-do OBGYN. These guys are sued regularly, unfortunately, and their malpractice insurance, et cetera, is through the roof. And that's one of the things we talked about. Look, we got to protect these assets. If one of these lawsuits goes through and penetrates to you personally, and they can go after anything that you don't have properly set up. So again, we want to protect you from the risk you don't know. We want to protect you from the taxes you don't know by proactively holistic planning. So, hey, listen, we're running out of time here, so I appreciate you jumping on the podcast with me, Keith. I look forward to seeing you. I think I'm going to see you in September at a conference.
Yeah, I'm going to see you in Arizona.
All right, very good. Well, hey, listen, thank you for taking the time to jump on. Again, we'll have this up on YouTube. We'll put the link to your website. It's Singer Wealth, and basically in South Florida. And reach out to Keith if you need help, or give us a call here at Retire Smart. Thanks for watching this episode.